Welcome students to Module 9. In Module 8, we saw how we can calculate the cost of equity, debt, and capital using the firm's existing financing mix in order to arrive at the discount rate or required rate of return for capital budgeting decisions. In those calculations, we were given the proportions of each type of finance. The question is, how do firms decide how much to finance their investments with equity and how much to finance with debt? How did they come up with the proportions of, say, 40% equity and 60% debt? Why not 20% equity and 80% debt? This is the financing decision. In this module, we will first consider the types of long-term equity and debt financing available, each of which has advantages and disadvantages. We will then examine how firms decide upon the optimal mix of financing. Just like investments decisions, this will be the right mix of debt and equity which maximizes firm value. This is important in that the financing decision impacts the firm value through the discount rate, the WACC, and is just as important as the investment decision. That is, firms may have good projects, but many a firm has come undone by not financing its investments appropriately. We investigate the optimal capital structure by looking at the theory based on 3 cases. We finish the module with a discussion about other issues to consider when raising capitals. How much capital to raise? How much of this is to be raised externally? Should external funds be raised via capital markets or financial intermediaries? Companies sometimes issue debt or equity, not only because they need the money to fund an investment project, but also because they want to alter their capital structure. This behavior suggests that managers believe that there is an optimal capital structure. In other words, they want to maintain the target debt-to-equity ratio or to reach the right mix of debt and equity that maximizes their company value. These are the sources of long-term financing: ordinary and preferred shares and long-term debt. Research has shown that companies in general prefer internally generated funds to finance their projects, that is, funds from their retained earnings. The decision of internal versus external financing depends on, first of all, the dividend policy, or how much dividend is paid, because the firm retains what it doesn't pay, and this links the dividend and financing decisions. It also depends on the management's decision to build up or reduce working capital over time, and also depends on the higher legal and transactions cost of external funds. Marginal benefits of raising capital externally is the ability to raise greater sum of money per dollar spent to acquire financing. The marginal cost, on the other hand, of raising capital externally are transaction costs, legal and other costs, which usually decline per dollar of capital raised. The 2 basic ways in which a business can access external finance are debt and equity. If the firm chooses debt, it promises to make fixed payments in the future, the interest payments, which are tax deductible. This is the claim of debt holders to the firm. With debt, managers have no control as to the terms of the debt, interest rate, changing the maturity, or other covenants. For small private businesses, it usually in the form of bank loans and leases. For larger publicly traded firms, it can take the form of corporate bonds and commercial paper. With equity, shareholders get whatever cash flows are left over after debt payments have been made. Dividends are not tax deductible for the firm. However, with equity financing, management has control as to how much dividends to pay and how many shares to issue to investors. For very small businesses, it can be the owners investing their savings. For slightly larger businesses, it can be venture capital or private equity. Or for publicly traded firms, it is its common stock that is issued on the exchange. The type of financing a firm will choose depends on the growth stage they're at in the life cycle. The transitions from one stage to another, from startup to rapid expansion, from expansion to growth, and so forth, are all motivated primarily by the need for capital. In each transition, though, there are costs incurred by the existing owners. For example, when venture capitalists enter the firm, they will demand their fair share and more of the ownership of the firm to provide equity. When a firm decides to go public, it has to trade off the greater access to capital markets against the increased disclosure requirements, loss of control, and the transaction costs of going public. When making seasoned offerings, firms have to consider issuance cost while managing their relationship with equity research analysts and ratings agencies. Not only the choice of financing depends on the growth stage of the firm, but also on the taxation laws and financial markets in their country. How firms finance has to do a lot with taxation. We know that interest is tax deductible in general while dividends are not, and this varies significantly across the world. Financing opportunities also depend on the financial markets available. For example, the US, and to a lesser extent Germany and Japan, have a well-developed corporate bond market that is available to even medium-sized firms. The corporate bond market in Australia has always been less developed, not only because of the more rigid regulatory controls, but also because of the relatively small size of the market. As a result, large Australian firms are more likely to issue bonds, if any, internationally, like Samurai bonds, Yankee bonds, or Euro bonds. Likewise, US, Japan, and Europe have well-developed equity markets for smaller and startup firms, like Nasdaq, JASDAQ, AIM, and so forth. The track record of second-board smaller firms exchanges in Australia has also not been strong. As a result, small firms in Australia are restricted to bank finance and retained earnings, with only the larger firms available to access exchange-traded equity on the ASX and a small number of blue chips international securitized debt. Let's look at equity financing. Ordinary shares are the basic ownership claim in a corporation. Shareholders share directly in the corporation's profits and losses after debt holders are paid. However, if the firm is liquidated, ordinary shareholders are paid last. We say they have a residual claim to firm value. The most shareholder can lose is the amount of their investment in the firm. Shareholders elect a board of directors who monitor the activities of the company's management. The election takes place by the shareholders casting votes at annual general meetings. Not all shareholders have equal voting rights. Generally, most shareholders in Australia do not actively engage in these meetings. They are relatively passive investors. Preference shares also represent an ownership interest in the company. However, if the firm is liquidated, preference shareholders will be paid before ordinary shareholders. Because preference shares have a fixed dividend that must be paid, they look like bonds or debt securities. Convertible preference shares can be converted into ordinary shares and are usually issued at $100 face value and have a set dividend for at least 5 years. At the time, the holders may accept the reset terms of the issue, get their money back, or convert to ordinary shares. When companies want to raise funds through the issue of new equity, they go to the primary market. This very first offering of shares is called an initial public offering, or IPO. The firm receives the proceeds of the IPO and investors receive the shares. Once the shares have been issued as an IPO, subsequent selling and buying of shares is done on the secondary market. The secondary market just provides the means of transferring ownership of shares, so the firm gets no funds from the secondary market trading. Secondary markets are important as it is here the market price is determined. The investors, through buying and selling shares, will determine the price, which will have an influence on how the firm will access finance in the future. These are some numbers on the Australian equity raisings. For example, in 2014, almost $8 billion was raised from initial public offerings. Taking in consideration the share buybacks, the right graph shows the net equity raisings split by financials and non-financial companies. The first table shows exactly how the capital was raised, whether it was in the form of IPO, rights issues, private placements, options, or dividend reinvestment plans, and others. While the second table presents the number of companies listed on the Australian Stock Exchange, their market capitalization, and how many firms are domestic firms. To be eligible for listing on the ASX, companies not only must pass the profit or asset test, but also must ensure a minimum level of investors to have registered an interest in to purchase shares. Once they're eligible, these are the initial and annual fees that must be paid based on the market capitalization of the firm. It can be quite substantial, and that's why being listed on the exchange requires additional funding from the firm. Raising funds through an IPO has the advantage that you can access large sums of capital in one go, as opposed to venture capitalists, which provide funds from about 10 to 40 million. Publicly listed shares can be used as payment in acquisitions of other firms instead of paying cash. Share options can be an incentive for managers to join a firm. It provides wealth and liquidity to the founders of the company who might want to retire and cash in their investments or diversify. Also, the process of going public entails promotions, advertisings, etc., which can be good for making known the products or services of the firm. The main disadvantage is the cost. Paying for underwriters, ASX fees, as we saw in the previous tables, printing of prospectuses, etc. These costs can reach substantial amounts. The time spent by managers planning and going through the IPO instead of focusing on the running of the business. The constant focus on maximizing the share price and investor relations. And like politics, once you're out in the public domain, every move and comment you make, every data you publish will be scrutinized by the media. Not only that, but ASIC, corporate governance rules, apply and must be followed once the company has become publicly listed. The next couple of slides present specialized types of IPOs. An equity carve-out is where, for example, the parent company sells 20% of subsidiary via the IPO. Thus, the subsidiary is a public company which is still controlled by the parent, who owns 80% of it. These transactions allow conglomerates to raise funds and evaluate their growth opportunity through different lines of business. It can allocate capital more efficiently and evaluate costs and opportunities better. An example of such IPO was Peter's Ice Cream carve-out from Nestlé, which we know it's a conglomerate. A spin-off is when a public parent company creates a new company with its own shares from a division or subsidiary. For example, American Online was a spin-off from Time Warner. A reverse leverage buyout, or RBO, is also known as a secondary IPO, is when a formerly public company has gone private through the LBO and now wants to go public again. Just Jeans was initially a public company who went private, then went public again under the Just Group name, and now unfortunately is delisted. Tracking stock is equity issued based on the earnings of a wholly owned subsidiary or division and considered a hybrid stock as they're not independent from the parent firm. Seasoned equity offering is when a public company with shares already trading in the market issues additional shares. This is not very popular with firms because it conveys negative information to the market. Investors believe that managers will not sell shares unless they consider it overvalued, so they sell them to get more money than they're worth. Or the market believes that the company is short of cash and in need of funds, therefore not enough earnings expected. Because this perceived negative connotation with SEOs, research has shown that share price falls following announcement of a seasoned equity offering. Managers surveyed report that one of their concerns regarding seasoned offering issuance is the share dilution. This means that the same earnings will be divided by more shares, thus less earnings per share. Also, they were concerned about the negative effect of issue on the price of the share or the issue price itself. Others said that they will consider seasoned equity offerings to maintain the target debt-to-equity ratio and a less risky source of funds. Rights offering means that existing shareholders are allowed to buy shares in a seasoned offering at a discount price, or to sell that right to other investors. This allows them to maintain their proportionate ownership in the corporation by not having new investors in to dilute the earnings. Private placements are sale of securities to few investors, in general institutional investors and pension funds. The advantage of this scheme is that the process doesn't require the strict scrutiny, registration and filing of an IPO and are less costly because of that. Because of this, the limit of private placements in Australia is 15% and up to 25% for small to mid-cap firms.